I brought along a few slides, so thank you first for the invitation to be here. I've been honored some time back an award as Friend of Singapore, and I really am a friend of Singapore. I come here 3-4 times a year. I see in my former capacity Ed Koh here, who's our representative and chief executive officer for Singapore for UBS. I spent 10 years working with Ed when I was at UBS, and I just left before the takeover. So timing is everything in finance. I'm very honored to be back here. I used to come here for about 10 years when I was the governor of the central bank, and the Bundesbank and the MAS had a long-standing friendly relationship, and I always remember the IMF meetings in 2007 when we were hosted here by Singapore was one of the big events just before the storm broke out in 2007. So thanks again for the invitation. It's an honor to be here. As was just indicated, I wanted to start by setting the stage a bit for how I look at the world. And, you know, I must make the proviso that basically what you hear is my view. It is frequently challenged, and, you know, it's also somewhat challenging for the central banking community, that I think that the recent burst of inflation was an unnecessary journey, and it could have been prevented at least to some part. What I plotted here is, to set the stage, the ultra-loose policies that set in after the financial crisis, and what you see as percentage of GDP is the evolution of central bank balance sheets in the major countries. Switzerland, where I lived for the 10 years, almost holds the golden ground still when it comes to percentage of GDP, but very recently, both for Switzerland, but also for the other major constituencies, central bank balance sheets have come down. If you add all of these up for a number of countries, doesn't seem to, do I have to point this? Huh? Oh, okay, but it doesn't show here, so I have to look, okay, I'm sorry, that I have to now go and look over there because it doesn't show here. So this is the central bank balance sheets that you could see. Now, when you add them all up and you take G4 central bank balance sheet as a sum translated into a single currency, and you plot that against any major equity index, then you will actually find that these equity indices are very highly correlated. And in particular, the various rounds of quantitative easing are very much associated with major movements in the equity markets. And I used to make the joke when I was at UBS, and our investment bankers told me that they need a lot more remuneration because they're doing so well. My point was always, well, I would need to pay Ben Bernanke, Janet Yellen, and Jean-Claude Trichet, but I can't. And so let's really look at what is idiosyncratic performance and what is the general tide that lifts all the boats. And I think in terms of the underlying forces that drive markets, I do think central bank balance sheets and liquidity in general were a major factor in the recent equity booms. Now, when you look at a correlation, this is sort of, you know, macro 101, you just simply plot them, you can see there is obviously a positive correlation, which even if you throw a standard error band around it, seems relatively tight. Now, we know those series aren't stationary series, so you have to do some econometrics on them before you can actually do that. But I think it's nevertheless striking that in terms of levels, these series co-move so much. Now, let me talk a bit about how it all went wrong in terms of central banking. And I think one of the biggest problems is, and you can see that in speeches like from Christine Lagarde, who basically called her economists a tribe, you can see that there is a certain division between the leadership of some of these central banks and the economic department, because nobody saw this coming. And actually now the heads of central banks need to stick their heads out and take responsibility for a policy that went wrong, largely based on forecasts that weren't really working very well. Now, I look at, and this is one of the 3 slides where I have some text, I look at this as something that, if you look at average inflation targeting, which was something that my friend Rich Clarida, who I meet a lot, has really advocated, I think it is really an ill-designed monetary policy framework, and if it's not ill-designed, the use of it has not been adequate. It basically means a too late tightening by design. It, in my view, really caused a policy error by the Fed that was waiting to happen. the average inflation targeting really matters. If you look at it, it's actually price level targeting. And I can tell you, when I talk to central bankers, did you ever see a plot of the price level? Everyone tells me, I've never been shown any of those. I'm going to talk about the price level rather than inflation. And I do think that if you target something, you better look at it occasionally. If you do price level targeting, then you need to look at how the price level evolves, and you need to have a good econometrics around that. It probably is more a co-integration framework that you need to then apply rather than the model frameworks that have been used. Two great blind spots developed in central banking, in my view, over recent years. The first one was that the inflation rate focus basically meant there was a built-in recognition lag of around 12 months for any break in the price trend. And if you look at the pandemic meant that basically governments put 25% of GDP out there in terms of paychecks and fiscal support, and it was largely funded by a 25% augmentation of central bank balance sheets to fund a lot of that. So a massive 25% of GDP fiscal and monetary stimulus. Anybody that ever did Macro 101 would have expected this is going to have an effect. And it did, but unfortunately, raking some of these effects in happened too late. The inflation forecast added, in my view, another built-in illusion that prices would eventually return to average, to the inflation target, and basically this led to, in my view, a lot of complacency in the camp transitory, because the 2% inflation projection long-term is a model assumption built into these models rather than an actual forecast. So the models were actually trending back towards 2% by construction, and many policymakers took that as a prediction of an inflation pressure that is going to ease over time. I think that really caused a problem. There were two more problems. The first one, forward guidance, in my view, also had a bit the problem that it suggested that central banks knew more about the economy than they actually did. And finally, there was a very awkward sequencing of central bank policies who all promised that the balance sheet policies, which is tapering and ending asset purchases, would all happen before hiking for the first time. And it was pretty clear the ECB only moved in June because they locked themselves in the tapering for another 3 to 4 months after the Fed has moved, and couldn't touch rates without reneging on a promise. So I think there was a very stylized setup on how you run monetary policy that basically I find quite counterintuitive. And if you look at the inflation numbers for the Eurozone, and these are the predictions of the ECB, you can see part of the problem that with every initial rise of inflation, the inflation forecast was mean reverting, and the higher initial inflation, actual inflation was, the more mean reverting these forecasts became, and they all ended up at the policy relevant horizon, which is a 3-year model prediction, to be back on target. And policymakers might have taken that as a sign that less action is needed. If you make these forecasts like you do an oil price forecast or an exchange rate forecast, and you forecast the status quo over the entire horizon of the rest of the projection, you have a completely different set of rules and indicators that warrant a lot more action on the side of central banks. So I think complacency built on these forecasts was part of the reasons. I like to look at the price level. If people go into shops, they don't care about the inflation rate, they care about prices. And actually, when you look at the inflation forecast of the ECB, this is what I've done here. I put the inflation forecast of the ECB into the level series, and you can actually see that for most of the policy non-adjustment period, prices continue to rise, and the ECB continued to predict inflation or future price rises at a rate that was way below the actual price level increase. So they were late. The same is true for the US. If you look at professional forecasters, the mean reversion of the models used by central banks really had the same effect here. Everything's all right in the long term, but it wasn't. Let me tell you the picture I like. This is a very simple picture that requires no econometrics. It's the price level. This is the CPI for the US over the period 2014 after the initial stabilization after the financial crisis, and the yellow dots are the forecasts that are currently there in the system. You can pretty much see that before the pandemic, that there was a below the, and the blue line that is there is a straight line that if inflation every month was 2%, you're on that straight blue line for the price level. And you can see that before the pandemic, because of the initial deflationary pressures, when you start the whole thing in 2014, I could have chosen any point here. I could have chosen 2015, then it would look basically on target. You had a rise in that price level that was roughly at the same slope as that blue line, so a 2% inflation, pretty much on target, with some ups and downs in the price level series. And then there's this period where inflation got completely out of line, and the horizontal blue line is when the Fed started tightening. It really needed a long time to understand that there was a fundamental drift in the price level, in the underlying dynamics, a trend break in the price level. And as soon as monetary policy adjusted, and I'm connecting the latest data point to the first data point after the policy adjustment, and for any integrated series, that will tell you the rate of change over the average of the period, which average inflation targeting should. You can see that that line is almost back to where the blue line was, but it's not quite where the blue line is. So inflation is somewhat above 2%, but not massively. And then when you look at the forecast, it's actually coming down at a rate that suggests that over the next 12 months, inflation is going to be below 2%. That's what the yellow line tells you. The line across the yellow dots tell you. But the real period where it went wrong was between the pandemic and the first tightening. And I remember when I was at UBS, and the Swiss government said, you got to stop paying dividends because things are really bad. And I said, hang on, guys, we'll wait till October. In October, if we're still alive and no problem occurred, I want to pay the second part of this dividend because then things are fine. So if you would have acted by the second half of 2020, you would have seen at that time the headlines in the news were economy at escape velocity. Escape velocity is what a rocket needs to leave the Earth. So if the economy was at escape velocity, why wait for another 2 years before you tighten rates if you can see a trend in the price level that is so out of whack with historical behavior? And this is not just a Fed thing, it's not just the CPI. Here you can see for the PCE, the Fed's preferred price level, that rate slope is somewhat lower for the same data. The same increase is a bit more deterministic because more volatile parts of the price level series are excluded in the PCE compared to the CPI. And you can see the same story is there. Things are all right again when it comes to the forecast, but the actual inflation figures, the trend still doesn't look quite at 2%. And this is one of the reasons why I think the Fed is cautious about loosening monetary policy at this juncture. I think they more want to see inflation in the rear mirror rather than just in the forecast. And they've grown somewhat wary of these inflation forecasts. The ECB has a somewhat different problem. You can see that in 2015 and 16, the price level didn't leave the initial 100 line. So inflation was roughly zero. This is where the ECB started talking about deflationary risks. I think this was a big misnomer. Deflationary risk doesn't mean a stable price level. It means a cumulative decline in prices. There were 2 seasonal episodes of prices being back at 100. So I do think the whole 2015 to later period showed you one thing, that on average in the Eurozone, inflation was 1.5%. It was suboptimally low. And when you look at the difference between the black line and the blue line, if you were a price level targeter, that would be the room to maneuver that you could allow yourself for inflation to pick up and bring you towards that blue line, but then you would have to break that. If you put the line in again till the first move in the ECB, this was in the middle of 2022, you can see that it took a long time also for the ECB to react. You can actually see that in the earlier 2022, a huge jump in the price level in the Eurozone because of the Ukraine war and of energy prices, which is an idiosyncratic Eurozone feature. It wasn't there in the rest of the world. And the same feature here, inflation still somewhat uncomfortably below 2%, but not massively. Would I really spill beans over that 2 different slopes? No, I wouldn't. But I think in the forecast, again, inflation is down to where the 2% is. Now, if you take the longer period, the problem you have with these, and this is the acceleration, if you really take a break point again with the Ukrainian war, you actually get an even more steepening in Europe, which left European inflation rates to go above 10%, as opposed to the US, where it stayed below 10%. So if you take this series, Jean-Claude Trichet And to a large degree also, Mario Draghi could say inflation under my watch was roughly 2% because the price level moved along that blue line with some small differences. This is not something Christine Lagarde can say when she leaves office because the price level has really rocked by more than 10% and it's very hard to bring inflation down. So how central banks are going to fix this? They're trying to fix it with two policy measures. The first one is tighten balance sheets, reduce liquidity. And here's a picture from the FT, which basically shows how much central banks are reducing their balance sheet, and it is actually quite sizable. You saw it in the first picture. The ECB in particular, you know, it looks a bit like the back of a dromedar here. This is the longer-term repos, which run out by construction, if not prolonged. None of them were prolonged. We're past that red part of the ECB balance sheet. And then you look at the decline of the ECB's balance sheet over the next 10 years, it's roughly deterministic. When you inject liquidity, it always provides markets with liquidity when needed, ambly. If you reduce liquidity, it's a non-event. It should happen almost in deterministic steps over a long period of time in order not to rock market. And this is exactly what they're doing, and that's the right thing to do. But what they did with interest rate to rake in inflation is, you can see that here from a Bloomberg chart, it's the most synchronized cycle of rate hikes that we've seen globally, and it's also been the fastest and the steepest rate hike cycle from bottom to top. And you can see that if you look at it for the Fed, the red one is the actual cycle. There was only one or two cycles where Paul Volcker occasionally tightened rates by 1% or more. The Fed never did more than 75 basis points, but they did 75 basis points at every meeting. So the steepest and strongest rate hike cycle in post-war history. The same for the ECB. They only had 3 cycles in their lifetime, and you can see the current one is the steepest cycle as well for the ECB. What do markets expect now going forward? And that's my job now, is to help people invest. So I look at forecasts. These are the forecasts, the gray area. The market expects a massive reduction of interest rates. I've been on the record for about a year saying this is wishful thinking. You know, it's completely unlikely that central banks will do this for various reasons. And if you look at, and Ed will see that this is our current UBS forecast. I've borrowed it from the UBS publication. You can see that for the Eurozone. What's happening with rates, when rates get predicted by central banks or banks, is the whole mean reversion feature of these models come in. So if the bottom of those rates was minus 1% and the top is 5%, guess what the long-term average projection is? The middle of the two. That is a model assumption rather than an actual prediction of what will happen. And that's why I think the market at the moment had to be on a journey. You know, and here's previous rate hike cycles, and you can see that on average, central banks reduced rates after a few weeks at being at the peak. And the market takes this pattern as a given for the future. Now, there are reasons why rates, when they peaked, came down, and I'm going to talk about that. But what you see is quite astonishing for the United States. The United States markets have been through a full rate hike pricing and repricing cycle of 125 basis points of pricing in rate cuts and pricing them out again. And my point about a year ago was, don't even start pricing it in because it won't happen. If you enjoy round trips, that's what you saw. Please go and have a round trip. If I look at the data, I never thought this possible. We're back to where we were, and that's appropriate. Now, here again, in some other form, the repricing and pricing of what happened to rates in the major constituencies. And I think you have to ask yourself why markets have embarked on this really outrageous repricing journey and priced it all out again. And I think it was wishful thinking. It does help you in your books if you can put in your books a forecast that says rates will be down at a 2-year horizon. Now, if you look at some rules, and again, this is just pulled off the Federal Reserve's tool set, it tells you that still in terms of a Taylor rule, where we are now is probably still appropriate, and tightening prematurely is probably not things people should do. I think these models predict too high rate moves when they're actually applied in situations where there are extreme changes in circumstance. So this is the volatility But I think if you look a snapshot at where we are now, there's nothing wrong from a Taylor perspective with a rate that's between 5 and 6% for the US economy, in my view. Let me skip a few because I don't want to run out of time. But when you look at why rates come down, I want to leave you with those thoughts. There are three major reasons why rates come down. The first one is a recession. And if you look at the probabilities of recession over rate hike cycles, some of the major interest rate reductions happen when the economy enters into a recession. So ask yourself, how likely is it that we're entering into a recession? The probability of a recession at the moment are very, very low. Actually, if anything, the US economy is extremely strong. Even the labor market is performing very, very strongly. So do I add a gray bar at the end of this series? I tell all of my clients, don't, because it's very unlikely. So a recession is not a reason why rates would come down. The second one is credit market and financial market problems. And I think if you look at credit, you can actually see that compared to previous credit cycles, the credit market is in somewhat of a recessionary state. There is a big reduction in credit in the US economy, but actually, if you take a bit of a deeper look between private credit and credit in the surveys that the banks do, one of the reasons that you might take a slightly different picture is private credit is now a substitute that is inadequately put into these figures. If you add private credit, it doesn't look quite as bad as it does here on the statistics for credit the Fed basically puts out. Financial crisis. Ken will talk after me. The start of last year when Credit Suisse and Silicon Valley Bank and others happened, it looked like financial stability could be an issue. Most of those things happening then were idiosyncratic and they're largely ironed out now, so I wouldn't worry too much about that. Bea, who has been a board member at UBS for almost 10 years, will talk about the Swiss particular problem with Credit Suisse. I have a few slides. I'm probably not going to get to them, but let me rest you with one idea. It was an idiosyncratic event. It was not an example of why there would be a general problem in finance. Same for Silicon Valley Bank. There are many reasons why these banks had troubles. General financial stability issues were not part of it. And so when my clients ask me, so what do you make of interest rates? I always refer to this chart. This chart takes the entire US rate cycles and divides them into two. It divides them into the rate cycle and rate cuts that happened in a recession or in a financial stability problem, and the ones that happened without that. And what you can see, if I were to make a prediction and I rule out financial instability, I rule out a credit crunch, and I rule out a recession, rates on average would come down by between 0.5% and 1%, taking the peak of the rate cycle because they went restrictive with tightening monetary policy. If I were to expect a rate cycle a recession, it's adequate for markets to price 3 to 3.5% rate reductions because that's what would happen in a recession. The Fed would have to react with strong rate cuts to a recession. And I think one of the reasons that why the market priced it in and priced it out again is that the probability of a recession, of a hard landing, has increasingly been watered down and priced out. And so part of the pricing of a hard landing has really disappeared. And you're back at max 1% rate move over the next year. And actually most of the commentators that look at the Fed think the Fed won't even move this year. I think they will. I think they will towards the end of the year, but I think probably can afford to wait after the election, and after the election they're probably going to start a rate cut cycle, but it's going to be one where they take the edge out of 5% rather than go all the way down to where they were. Another indicator that I don't want to go into is inflation will only bottom out after there has been a recession, so since I don't expect a recession, I don't have to be long about it. This is the other part that I always refer to. If you take the same rate constellation between rate hikes and rate cuts in recessionary and crisis mode and normal mode, you can actually see that if there is a recession, the stock market usually falls and interest rates are cut, and that's because earnings go down, demand goes down, and all the usual things happen with multiples that the stock market reprices on the way down. In a non-recessionary, non-financial crisis environment, the stock market usually continues to go up. So people are quite astonished at the moment why the stock market continues to boom. Well, the stock market always had an upward drift in periods where there was no problem on site. And so what is happening in the current market environment, for me, is not at all surprising. There's not going to be a rate cut cycle that is noticeable. It takes the edge off. And that is not something that will fundamentally undermine the stock market because it's driven by liquidity. And liquidity in the central banks is withdrawn over a longer period, almost at glacial forces. And then, of course, you know, I don't want to go into this because I promised Edward that I'd be on time. So let me just simply allude to two problems that will be my two last slides that I won't go. The market, in my view, is looking in the wrong corner for problems. And you saw maybe some news again this morning on Bloomberg that the one market that looks stretched is not the credit market, but actually central banks, in my view, are underestimating the results of this very sharp tightening on a number of markets, and in particular on the most, I would say, business and rate sensitive markets, and that is the credit market. And one proviso I'm going to make is we don't know a lot about the credit market because a lot of credit has moved to private credit, and there's much more vulnerability in private credit than there is in credit in established financial institutions, which are regulated and have capital requirements. So watch for that private credit market corner. And I do think you can already see it, and that was the start of the repricing of Silicon Valley Bank. There were massive hidden losses in the mark-to-market environment in the balance sheet of Silicon Valley Bank. One of the reasons why Silicon Valley Bank imploded is that actually now that rates have moved up so much, there's a complete repricing of your book, and there are mark-to-market losses. If you were to price these previous credits at 0 or negative rates to the current rate environment, if you want to sell any of these credits prematurely, you take a big discount. So what banks do is the same mistake they make every time there is a cycle. They basically move the stuff from available for sale to hold to maturity in order to isolate it from anything happening to these credits, and then they pray. They pray that nothing happens over the lifetime of that bond, because if they were to, rather than have it mature, prematurely sell it, they're going to realize these losses that they try to isolate themselves from. Remember 2007? That was the story. Do we exclude this story now? I think it'd be premature to exclude these stories. You can see open-ended and closed-end real estate funds in the US at the moment basically paying out, if they close, at 60 to 50% of initial value. So there's a lot of stuff happening. And as long as the market booms, nobody needs to sell. But if the market turns, you will see sales and you will see loss materializations. Mark to market and hold to maturity is going to be the usual avenue where these weaknesses develop. And finally, I do think that the big area of non-financial intermediation and private credit and new types of credits is something that both regulators and central banks have very little experience with. I can tell you, I work a lot with private equity firms. And you know, private credit sounds great, in particular if it comes from a private equity firm. But be aware, if a private equity firm sells private credit, those are the credits that didn't make it into their portfolio. You know, there's already an adverse selection that has happened. If they offer a financing available for sale, it's not one where they put the project into their fund. So there is an adverse selection process happening in many of these private credits, and in my view, private credit has the big risk that the usual regulatory developments that we've seen for banking didn't take hold there. I'm always wary of areas where arbitrage between regulated and unregulated parts of the market is taking hold, because then when the market corrects, it's going to hit you in the unregulated part that use the arbitrage of no capital, no liquidity ratios, and of course it means they have no capital and no liquidity buffers when push comes to shove, and that's where the losses will materialize. So watch out for private credit. The second one is, when you look at Credit Suisse, I'm not trying to steal Bear's line here, but in banking, everyone always makes the same mistakes. The reassurance, it's different people that make the same mistakes, okay? Different generations. And you can actually, this is the list of what I usually come up with, what went wrong in banking, and I think it's 8 points, but it's very clear. High concentration risk and undiversified business model. That was Silicon Valley Bank, that was First Republic. High leverage, excessive risk-taking, that's behind many of the stories. Insufficient risk culture and inadequate risk management. I'm sure Bea is going to talk about that to some degree. Insufficient liquidity buffers and inadequate capital buffers. Actually, for Credit Suisse, that's the really astonishing part, because under a Swiss regime, you could not have sufficient capital and liquidity buffer, so something else must have gone wrong, and it did. Sudden loss of confidence in the financial institution and contagion to similar institution. I think that is something that basically was there both for Silicon Valley, First Republic, and Credit Suisse. In my view, these were wealth management runs. Wealthy clients lost the confidence in that bank to be run well and moved their money somewhere else. Sudden loss of confidence in financial institutions is one of the most hardest to control areas. A bank like Credit Suisse losing half of its deposits within 3 months is a crisis of confidence rather than anything else. Lack of efficient regulatory framework, I think that's being debated, and I think Bea was part of the discussion here in Switzerland on whether the regulatory framework or lack of supervisory scrutiny was part of the picture. I think you can probably make a point that it's more the latter than the former, supervisory scrutiny, that played a role when it comes to such a sudden loss in confidence. So, in my view, I tried to convince you of 3 things, and I hope I at least succeeded with 1. The whole reflation episode was wholly unnecessary if central banks had reacted early and looked at the right things. Second, trying to rake that in so far happened at almost negligible cost to the economy. So far, so good. Third, don't take that as a great guide to the future. There could be risks, in particular in these last 2 slides, that are out there that are going to materialize over a longer period of time. I always find it astonishing to close on that. We're 3 months, 5 months, we're 6 months, maybe 8 months into the end of the rate hike cycle. And people talk about the entire adjustment process having gone well. An adjustment process after a rate hike cycle like this takes 2 to 3 years. We're into 8 months. Keep safety belts fastened. It's not going to be as easy a journey as the first 8 months were. Thank you for your attention.
Thank you very much, Professor Weber.